Expected credit loss is the technical term at the center of Ind AS 109, but it is built on a foundation you already know. ECL represents the Ind AS evolution of the provision for doubtful debts. It takes that basic concept of preparing for bad debts and applies a more systematic, forward-looking methodology. Whenever a company holds a financial asset, such as a loan to an employee or a trade receivable, there is a risk the counterparty might not pay. ECL is the provision you create to reflect that specific risk on your balance sheet before the loss actually occurs. Standard accounting rules like Ind AS 37 cover general provisions, but for financial assets, the rules are different. Ind AS 109 takes over here because these assets require a specific calculation based on credit risk rather than a general estimate of future obligations. Understanding ECL isn't about memorizing a new category of accounting. It's about applying a precise regulatory upgrade to the familiar practice of provisioning, specifically tailored for the complexities of financial instruments. Your first step is determining the time frame for the provision. If the credit risk is low, the standard requires a 12-month ECL, covering only the losses expected in the coming year. However, if there is a significant increase in risk, you must calculate the lifetime ECL, covering the entire duration of the asset's life. To calculate this accurately, we use a 3-step framework that breaks the technical requirements into a repeatable process. Step 1 is determining the provision rate. This is the probability of default, the chance they won't pay, multiplied by the loss given default. This calculation requires precision because it involves a percentage of a percentage. For a 1 lakh debtor with a 20% probability of default and a 5% expected loss, multiplying the two figures results in a 1% provision rate. In Step 2, you apply that rate to the asset. Multiplying the carrying value of 1 lakh by our 1% rate results in a loss allowance of 1,000 rupees. Step 3 is the journal entry. You debit the P&L for 1,000 to recognize the expense and credit the provision for loss allowance. Following this sequence ensures you don't miscalculate the initial rate, which is the most common reason for losing accuracy on these specific problems. On the balance sheet, the provision is shown as a deduction from the asset. In this example, you report 1 lakh in trade receivables less the 1,000 loss allowance for a net carrying amount of 99,000. We present it this way because the provision represents the diminished value of the asset itself. It is not a liability owed to a third party. It is a recognition that you expect to receive $1,000 less than the face value of the receivable. To handle large numbers of customers, companies use the provision matrix. This approach groups debtors into aging buckets based on how long their payments are overdue, with specific default rates assigned to each category. Consider a scenario with 6 crore in total receivables. 50% are current, and 25% are between 1 and 30 days overdue. Take a moment to calculate the value of those individual buckets. To solve this, you must first calculate the amount in each bucket before applying the rates. 50% of 6 crore puts 3 crore into the current category. Only after you have that 3 crore figure do you multiply it by the specific default rate for that age group. Whether you are calculating for one debtor or a matrix of thousands, the logic remains the same. Categorize the debt by age first, then apply the historical loss rates to each group. To summarize, calculate the provision rate by correctly multiplying probability of default and loss given default. Second, for a matrix, evaluate age buckets before applying percentages. Finally, deduct the loss allowance directly from the financial asset, not a separate liability. Using these structured steps transforms a high-level accounting requirement into a methodical process, ensuring your financial statements reflect the specific credit risks required by the standard.